Assalamualaikum warahmatullahi wabarakatuh. My name is Asma Akila binti Muhammad Kamal Arifin. I am currently I'm studying in UiTM in Kelantan, campus Kota Baru. So today I would like to give my speech on conventional versus Islamic financing. So we move. Okay, first of all, what is Islamic financing? So let me give the definition of Islamic financing, which is a financial system that operates according to Islamic law of Sharia compliance. The features of Islamic financing is the same as the conventional financing, which are banks, capital markets, funds managers, investment firms, and insurance companies. Islam promotes economically productive activities and genuine trade and business transaction on one side, while it calls for avoidance of interest rate transaction, no involvement in illegal and unethical activities, and avoidance of speculative transaction. It means that as a Muslim, every transaction we make must be based on the Sharia compliance. And nowadays, in Malaysia itself, we in financial institution, we have Islamic financing and conventional financing. So the introduction of Islamic banking products will prevent the Muslim from participating in the non-Sharia compliance banking system. So next, let's we move on the conventional financing. Okay, this is the conventional financing. The definition of conventional financing is a transaction based on the interest rate for saving surplus or deficit spending units to loan or borrow funds in the financial markets. The features also is the same as the Islamic financing, which are banks, capital markets, funds manager, uh, and insurance company. So the conventional financing earns a profit from the interest charged on the amount borrowed by the borrower. It means that if the borrower borrow a money from the banks, uh, the interest charge will be given to the borrower based on the amount they borrowed from the bank. But in other side, if the borrower cannot pay back their their amount borrowed, so the bank will charge extra fees for them to be paid as they paid the amount late. So these charges we call as the profit for the conventional financing. So next is a value proposition of Islamic financing. Let me I have three I have 3 points here, the value proposition of Islamic financing. So you can see, right? So let me zoom to you. So the first point is that to ensure that Islamic finance remains a form of finance intermediation that serve the real economy, and that it will continue to benefit the society. It means that in Islamic transaction, the financial transaction will be underpinned by the real economic activities. This ensure its close linkage to the economy as as it direct the overall intermediation function toward economic production and wealth creation. So this means that for example, current the recent growth of Islamic finance has been fueled by a sustained phase of innovation. The scope of wealth management to sustain the trend together in-depth applied research is needed to develop more financial products. It means that in our country, so in Malaysia itself, you want this Islamic finance uh, will will grow will grow more. I mean for we also maybe in the future we want the Islamic finance will be fully applied in our economic system for the growth of the economy. So okay, the next point is to enhance financial inclusion and for being beneficial for to all members of the society. It means that the Islamic financing, there are we know that Islamic financing is based on Sharia compliance. Sharia compliance. So it is not the same as the conventional financing, whereby the conventional financing are based on interest base, and Islamic financing based on the profit and loss sharing. So uh, so this Islamic financing will give more benefits to all members of the society, not only to the Muslim but also to non-Muslim. Because of for example, if in conventional financing they have an interest base, but what if that person borrowed the make a loan and cannot pay the amount in the time given? So when they cannot pay the borrowed amount in the time given, so the bank will charge them a lot more of interest and extra fees. So that that will make them in worse situation, whereby uh, they have uh, more debt to go on their life. So if they join the Islamic financing, which are profit and loss sharing, meaning that every people, if there are a profit, for example, if they make the investment and there is a profit, high profit for example, so the profit will be given to the members, to all members, in types of dividends. So uh, but in otherwise, if their investment is not in a good situation where they suffer loss, so the losers will be shared among all of the members. So there will be this is what we call as a profit and loss sharing. So it is good actually. So my last point is it emerges as a new vehicle in bridging economies and contributing to increasing the financial linkage, in particular the to emerging the markets. So it means that previously Islamic finance was domestic centric. It is now increasing, providing the financial solution for cross-border trade and investment. So this means that not only financing, not only to borrow the money, but also in Islamic financing there are a lot of types we can make the investment through the Islamic financing and make a trade transactions through the Islamic financing. So the progressive liberalization has facilitated the internationalization of Islamic finance. This has been reinforced by the dynamic place of innovation in Islamic finance, and has the widen the range of financial products and services. The in the internalization process has thus contributed to the more efficient allocation of funds across border, from centers with surplus fund to regions with investment opportunity, and to diversification of the risk. Meaning that if any transaction we make with through Islamic finance, the risk will be the risk sharing. We call it as risk sharing, where not only that person uh, that will liable to the risk, but every member will be liable to the risk. So uh, the the risk ratio will be in a small amount for all the members. Okay, next is operational mechanism. Okay, this is operational mechanism. Okay, first of all, what is operational mechanism? Operational mechanism is the way on how the financial institution operates their business. As I mentioned earlier, in conventional financing, they generate their business through the interest base. Meanwhile, Islamic financing, they generate its business through profit and loss sharing and no risk. meaning that the risk sharing. So let's we go through the conventional financing. Okay, in conventional financing, all the transactions are based on the man-made law. It means that uh, it means that in conventional financing, uh, they are not based on the Islamic law, but they go through the man-made law, which means that we as a human being uh, make the law, and that law will be used by the conventional um, institution. So next is the Islamic financing. Islamic financing is based on Sharia compliance, which means Islamic law, which means where this Islamic law come from. So this Islamic law come from the Holy Quran that has been used by the Muslim. So in this Holy Quran, they have said what should Muslim do in financing system. So there are the rules and regulation that set up and has been told by our God Allah. So we need to comply and we need to follow all the instruction given by our God. So in conventional, the loan given need to be paid with interest rate. Yes, it is true, because the conventional system itself is their profit come from the interest rate. um, it means that if the borrower borrowed money from the bank, so the bank will charge the interest rate based on the amount amount based on the amount borrowed by the borrower. So this is a conventional. Meanwhile, in the Islamic finance, there are no such interest rate. It means that any transaction or investment made in the Islamic financing is based on the Islamic law, and there is no interest rate, meaning that the profit and loss will be shared among the members. So that's it. And the last one that I would like to compare is that in conventional, there are no risk sharing. It means that if the borrower borrow the money from the bank, so the borrower itself will take the risk uh, for borrow the money from the bank. It means that if the borrower borrow the money, for example 1,000 ringgit from the bank, so the bank will charge the interest based on the uh, borrowed amount. And this borrowed amount, if the borrower cannot pay it between the limited time given by the bank, so the borrower itself need to are liable to the risk, meaning that the risk is on the borrower, not on the bank itself. So as we can see in the Islamic finance, the risk is risk sharing, meaning that the risk will be shared by all the members in the Islamic finance. So in Islamic financing also, there in Quran also stated that in the financing of Islamic finance, there will be the prohibition of riba, gharar and maisir. What is riba, gharar and maisir actually? Riba is the usury we call it as a interest rate that will burden the borrower. So next is a gharar, which is uncertainty, which means that in Islamic finance, all the information need to be disclosed to the customer, meaning that so that there will be no uncertainties. So the last one is the maisir. Maisir we call it as gambling. So in Islamic finance, there will be no gambling at all. So, next, we move to the instruments of the financial institution. What is financial instruments? What is the financial instrument? So financial instrument can be real or virtual documents representing a legal agreement involving any kind of monetary value. So in this lab, we have conventional and Islamic finance. So in conventional, I put here, I have 3 points of instruments that has been used in conventional, which are: the first one is trade financing. Trade finance means that the bank defer trade finance related operation under the concept of services, guarantee, and lending. The next one is deposit or liabilities. In the conventional banks, accept deposits on the basis of the loan for all type of deposit account, including the terms deposit, saving, and current account. Interest-based return are the provided for the savings account and the term deposit, whereas current account may offer free banking facilities. So the last one is the lending and financing. It means that conventional banks offer lending facilities to their clients to fulfill their cash requirement of the basis of loan contract, where the relationship between the bank and the client is that of lender and borrower perspective. It means that if the customer want to borrow money from the bank, so the customer we call it the borrower, and the bank who give the money to the customer, we call it the bank as a lender. So next one, we move to Islamic finance. Okay, in Islamic finance, the instrument we have five actually. The first one is musyarakah, mudabarah, ijarah, istithna, and wakalah. Okay, what is musyarakah and mudarabah? Musyarakah and mudarabah can be called as profit and loss sharing, which mean musyarakah is a contract in which two parties agree on the capital share, and both parties are involved in the implementation and management of the project, and profit are divided according to the terms agreed in the contract, and the losses are allocated in proportion of the capital contributed. So it means that musyarakah is profit. So any profit will be divided to the members according to the contract. So if there is a loss situation, so the loss also will be shared with the other member. So mudarabah is the loss. The owner of the capital give money to the applicant, who is committed to managing the amount given with the view toward making a profit. So mudarabah is basically musyarakah and mudarabah is profit and loss sharing, meaning that all the profit will be shared among the members through the dividend, and loss also will be shared by the members in that has been stated in the contract. So next we go to ijarah. Ijarah is a lease contract whereby a party is given a right of use in return of a rental payment. The ijarah structure is usually used to the operational phase of the project financing in conjunction with the istithna structure during the construction phase. So let's we move to istithna to more for you to give you more understanding. So istithna is a procurement contract whereby payment is made by the buyer for good to be delivered at a later date. It means that istithna is the document usually for example in food for goods. uh, for example, there is a a shop, for example a mart that sell the goods for the consumer. For example, we take as Maiden will order the stock from the supplier, and the stock will come earlier, but they will pay it later. So that is mean istithna. So wakalah is an agency contract whereby the wakil acts in the agency capacity on behalf of the financial. So wakalah we call it the representative that acts as the agent to the financial. So lastly, thank you everyone. So that's all for my speech for today, conventional versus Islamic banking. I hope that I have give enough information for you guys. Thank you, and thank you also for my lecturer, Madam Nadia Farlina, for guiding me and has give more knowledge for me to complete this assignment. And thank you guys. And if you guys like this video, please hit the button like, and don't forget to subscribe this in the YouTube. Bye bye. Thank you.